I started posting my monthly investments at the beginning of 2025, when my portfolio looked like this. Since then, it has been nothing but pain and misery for investors, and for my portfolio, thanks to a whole host of global economic instability driven by US tariffs. But I will continue to invest a portion of my salary every single month. In fact, I'm actually going to be investing even more from this month onwards, because whilst I expect the stock market to feel some pain this year, I feel like I'll be looking back at my investments today in 5 or 10 years' time feeling very pleased. So let's go through how I invested £1,000 when I got paid. I put my money into 5 existing investments within my stocks and shares ISA. And the first investment I made this month was adding £100 to my existing investment in Duolingo, the learning app famous for its unhinged style, and the ability to convince you that it can actually help you become fluent in a language. I mean, hey, I'm fluent in Romanian now. Duo este o bufniță verde. Now, everyone might poke fun at this company, but I tell you what, it is a serious business. At its core, Duolingo is a language learning app that makes it fun and easy for people to learn and to stick with it. Over 110 million people use Duolingo every single month, and it has almost 10 million paying subscribers, like me. In fact, I've literally just hit my 500-day streak of learning Romanian. But these streaks are not just some gimmick. Around 25% of Duolingo's daily users have streaks over 1 year long, which shows pretty incredible engagement for any app, let alone one focused on learning. So why is some little language learning app now valued at almost $15 billion, and what does the future hold? For starters, the company is obsessed with iteratively improving the product. I mean, they test everything. The formats of the lessons, the difficulty, even where they place the buttons, in order to help people learn better and stay engaged with the app. And they're bringing that same approach to new areas like math, music, and very recently announced chess. The company is also investing heavily into artificial intelligence, which powers a new premium feature called Duolingo Max. Among other things, Duolingo Max subscribers can have video calls with the Duolingo character Lily to help practice conversational skills, which I think is a pretty cool tool for anyone truly wanting to learn a language. Now, one of many exciting things about Duolingo is the speed at which the company has grown. Revenue grew by over 40% to reach $748 million last year, with most of this coming from paid subscribers. The company has maintained this incredible level of growth for years, and looks set to keep growing at a rapid rate, according to analyst estimates. Oh, and it has done all this whilst being comfortably profitable. The company just ticks so many boxes for me. It has 2 co-founders, with Luis von Ahn in the CEO role and Severin Hacker as Chief Technology Officer. These two own over 16% of all the shares in the company. It has almost $900 million in cash with no debt. The company's social media marketing strategy is incredible and has driven massive brand awareness for minimal cost. To be honest, I could go on about Duolingo for the rest of this video, but that would probably be unfair on the rest of my investments. So I'll leave it at this. Over the past few years, Duolingo has shown itself to be one of the highest quality, fast-growing businesses around, and it ticks so many of the boxes that I look for in an investment, which is why I was happy to add £100 to my existing investment in Duolingo. My next investment is quite the opposite to a fast-growing disruptive tech company firing on all cylinders. It is global payments company PayPal, and whilst it's not a shiny new fintech anymore, the company is quietly making a comeback under its new CEO. Now, it's worth remembering that PayPal still processes over $1 trillion in payments every year and is one of the most widely accepted digital wallets globally. So it's still a massively successful business. But the last few years haven't been easy. Growth has slowed substantially, competition has really ramped up from Apple Pay, Cash App, and the likes of Stripe and Adyen. And let's face it, PayPal's app feels a bit outdated, especially here in the UK, where we have pretty strong digital banks like Monzo and Starling. However, under new CEO Alex Chriss, PayPal is starting to modernize. They've rebuilt the mobile checkout experience, added real-time payment features, and are overhauling their entire tech platform. This means faster updates, more personalized shopping experiences, and less friction when customers are checking out. Now, whilst all this is going on in the background, PayPal stock is still looking extremely cheap, which reflects the company's disappointing performance over the last few years. But I think investors have reason to be more optimistic about the future. Currently, PayPal's shares trade at about 12 times next year's earnings. That is, by any measure, very cheap, especially since analysts expect earnings per share to grow by over 10% a year for the next few weeks. So that's the thesis for me. Shares that look insanely cheap for a globally dominant business that has finally woken up thanks to this new management team, which is why I added £100 to my existing investment in PayPal. Now, before I get into my 3 biggest investments of the month, I wanted to quickly mention Trading 212. The investment provider that I've trusted with my stocks and shares ISA for the past 5 years. If you want to try it out, our viewers can get free fractional shares worth up to £100 if they use code SNSBonus when they join Trading 212. Could be Apple, could be Tesla, could even be PayPal. This is an affiliate link, meaning we get a commission if you join, and that helps to support our free content. Alright, let's move on to my 3 largest investments of the month, starting with Amazon, where I topped up my existing investment with £250. For me, Amazon is one of the best businesses in the world. It has an e-commerce business and logistics network that is in a league of its own. It has AWS, the world's largest cloud computing provider, which took in over $40 billion in operating profit last year, and it continues to lean into profitable growth segments like advertising, while still being able to invest in new moonshot ideas such as Project Kuiper, an initiative to increase global broadband access through a constellation of more than 3,000 satellites. Basically, Amazon's answer to Starlink. Honestly, I struggle to see a future in which Amazon does not succeed. The competitive advantage it's built with its logistics network, offering next-day delivery on basically anything you need, is virtually irreplaceable. Occasionally, we're able to go and live outside of the UK for a month or so at a time, and the ability to have whatever you need turn up on your doorstep the next day is something we rarely miss. What's also exciting about Amazon is the fact it's getting more efficient. AWS was already as profitable as anything, but CEO Andy Jassy has done a great job of optimizing the company's logistics network, and the result has been substantial improvements in operating profit margins. And this is expected to continue in the future. That's part of the reason why analysts expect revenue to grow at an average of 10% a year for the next 5 years, but they expect operating profit to grow at 20% per year, because that's what happens when a company making $500 billion a year in revenue gets a little bit more efficient. All this at a very compelling valuation. At the time of recording, Amazon's shares trade at around 27 times next year's earnings. That is a cheaper valuation than Walmart, despite Amazon's profits expecting to grow at a much faster rate. Basically, it feels like I'm getting to invest in one of the greatest businesses to ever exist at a very enticing share price. So I just had to top up my existing Amazon investment with £250. Now, I'm not going to dive into much detail about the next company, because if you've been watching these monthly investment videos recently, you're probably sick of hearing about them. Once again, I invested £250 in digital advertising company The Trade Desk, bringing my total investment in the company up to £3,500 and making it the 5th largest individual stock holding in my portfolio. Now, I won't bore regular viewers by going over it in detail. I'll just give a very brief overview. The Trade Desk operates a digital advertising platform that automates the buying and selling of digital advertisements, using a shed load of data to deliver better results for advertisers. For the years that I've invested in it, the Trade Desk has proved itself to be one of the best companies in my portfolio. But it had a misstep recently when it came to rolling out its next-gen platform Kokai, and that resulted in the company missing its own revenue guidance for the first time in 8 years. Combine that with a very upset stock market, and you have a company whose shares have been more than cut in half in just a few months. But honestly, I just think this is a bump in the road for a brilliant company. I trust the management team to right the ship, and I can't help but feel that it just looks like a huge long-term buying opportunity, which is why I've been piling into the trade desk in the last month or two, and why, if you've been watching these videos each month, you're probably sick of hearing about the trade desk. So I'll leave it at that and move on to the largest investment I made this month. This is actually a company I've invested in for over 3 years, but it's probably been the most neglected business in my portfolio. I hadn't added to it in over 18 months, despite it being one of the smallest holdings. But that changed this month, as my largest investment was in observability software leader Datadog, adding £300 to my existing investment. Now, one reason I think I've neglected it is because it's a more technical company, and I don't like things that hurt my brain too much. I forced myself to remember what this business actually does. At a high level, Datadog helps businesses monitor everything that's happening across their apps, websites, and cloud systems. Its tools help companies to fix bugs, track app performance, improve user experience, and spot security risks, all in real time. Datadog breaks this into 3 main areas of the business. 1. Infrastructure monitoring, which tracks the health and performance of the systems that run a business's applications. Think servers, networks, and cloud services. It helps businesses to spot problems like slow servers or overloaded systems so they can fix them fast and keep everything running smoothly. 2. Log management. Now, logs are simply records of what's happening within apps and systems, like a digital paper trail. Datadog collects and organizes these logs so teams can figure out what went wrong when there's an issue, and also how to make things work better. And 3. Application performance monitoring, which, as the name suggests, monitors how well applications are performing. This part of the business helps developers find and fix issues before users even notice. Now, a big part of Datadog's success is its ability to rapidly expand into different products and solutions, with Datadog's platform now offering a huge host of products. And the company's land and expand model has been working well. Land a customer, get them on the platform, and then upsell them additional solutions. This can be seen with the number of customers using multiple Datadog products. In just under 3 years, the share of customers using 4 or more Datadog products has risen from 35% to 50%. And when it comes to 8 or more products, it's gone from 2% of customers to 12% of customers. This is part of the reason why Datadog has experienced such rapid growth. Now, despite slowing down substantially in 2023 and 2024, revenue still grew at 27% and 26% a year respectively. Management recently told investors to expect 18 to 19% growth this year, which disappointed Wall Street, but I think this company has simply set itself up for a year of easily beating analysts' expectations. As a result, it allowed me to scoop up some shares at a much lower price. Analysts are still expecting revenue to grow by just under 20% a year for the next few years, and the future opportunity still remains pretty large for this $30 billion business. So I was happy to finally start giving it a bit more attention, adding £300 to my existing Datadog investment, making it my largest purchase this month. So that's a wrap on my investments for the month. If you want more videos like this, be sure to check out Andrea's monthly investment video that will be coming out next week. And if you'd like to follow along with our investing journeys over the coming months and years, don't forget to subscribe to this channel. Thanks a lot for watching, and I'll see you next time.